Good day, my friends. This is one of the most powerful videos you will ever see with regards to refinancing. You'll never look at it the same way. My name is Derek Evans. I'm a mortgage consultant. NMLS 155010. See the company MLS is 1938081. Call this the smarter way to refinance your home, the most efficient way to refinance your home, exactly the way that I do it myself. And you may think, well, how many different ways could there possibly be? Well, this is one that you've probably never heard of before. In fact, I almost guarantee it. And it is by far the most efficient. So I'm going to go through with you step by step how it works, how you can do it. Doesn't cost anything extra. We just use simply the resources available in the transaction. It is a beautiful thing, and it will blow your mind. So the backstory with this is that I've done it myself on my own refinances for 24 years. But the problem was that when I would try to explain it to clients, it was too difficult, too complicated. It was something that they just didn't quite grasp. And so I thought, well, gosh, I know it would be best for them to do it, but am I going to keep, banging my head against the wall? That's essentially the decision I was trying to figure out to make. And so I didn't tell people about it. I didn't even try for a number of years. And just recently, in the past refi boom during COVID, I started telling people again. It seemed like more people were grasping it. I was explaining it better. And that's why I'm making this video, so people can understand. And I call it the TriFecta Strategy. What does that exactly mean? Well, when we do the refinance, the goals, are to have a lower rate, obviously, right? Want a lower payment, of course. Maybe not every case if you're lowering the term or something, but for most people, we want a lower rate, lower payment. And then the third one, and this is the biggie, lower balance. Okay, this is the big one. Lower balance. If you can have a lower rate, a lower payment, and a lower balance, a lower amount owed on your loan than you did before you started the refinance, then that is the trifecta. And that means it's a no-brainer. But this is a big one. How do you end up owing less after a refi? This is absolutely huge. Most people, when they refinance, will just simply tack all the costs onto the new loan, and they will then have a deficit. They'll add those costs onto the loan, so the savings that you're getting per month need to eventually catch up with the costs you've paid before you actually start having a positive net impact on that refinance. So if there's one thing you learn from this video, when you do refinance, make sure you're looking at what is my loan amount going from and to. Because that is the place where you will either give the bank a bunch of money, or if you use this trifecta strategy, you will make yourself a bunch of money. And it is absolutely insane how this works. So what resources are available in this process? This is what we need to become aware of. Let's sidebar for a second. What are the available resources? Okay. So number one, you're going to get an impound refund. So right now you're paying your monthly payment. A certain amount goes for principal, interest, and then another certain amount goes for taxes and insurance. That amount that goes for taxes and insurance is called your impound account. This is like a separate account. Sometimes it's referred to as an escrow account or an escrow balance on your mortgage statement. This is an account that's separate. That's your money. The bank can't make interest on it. They can't charge you anything for managing this, but you pay into it and they pay the taxes and insurance. And so you're going to get an impound refund if you impound. If you don't impound, for the sake of this video, then you can just ignore it because it's essentially a wash. You have an impound account right now you're going to get a refund for, and you're going to have to start a new impound account in your refinance. And that's part of the cost, probably the biggest portion of the cost to doing a refinance. So if you don't impound and you're not going to in your refinance, then it just washes out. Just ignore that part of this whole process. If you want to know how much your impound refund is going to be, just simply look at your current impound balance on your mortgage statement. It may say impound balance, it may say escrow balance, but it will be on there. And if you need help with any of this stuff, reach out to me anytime and I'll show you how it all works for your specific situation. You're also going to get the potential to skip mortgage payments. Now, a lot of people in the mortgage industry will tell you that this is a reason to do it, or they'll use it as a marketing. Hey, you want to skip a couple payments? Let's do a refi. And people will buy it. Because if you get to skip a couple of mortgage payments, that's a significant amount of money. So we've got those things going on here too. Those are part of the resources that are available here. Because if you weren't going to refinance, then you would just keep making your mortgage payment, right? Yeah, you would just keep making it. So it wouldn't be, if we use these resources here for these mortgage payments that you could skip, and we use those in this transaction, then you're going to be able to have a much better situation at the end of the day, a much more efficient situation. So these payments that you can skip these payments if you prefer inefficiency. But the whole point here is that your home loan is your biggest debt. And so it is the most important one to be efficient with. If you're going to be inefficient with your car loans or your credit cards, okay. You've got a $10,000 balance on your credit card and $20,000 in savings, and you just don't want to pay it because you like the bigger number in your savings account. Okay, but that's not efficient. That is not the smartest thing to do. Okay, so when we're talking about what we're doing here, this is the most efficient and therefore the smartest thing to do with your biggest debt. So we're going to use the impound refund, and we're going to use these skipped mortgage payments. And instead of skipping these mortgage payments, we're going to actually take the amount that we would have paid and we're going to apply it towards the new loan after the refinance is complete. So cool how this works. Because what happens now is if you had just made these mortgage payments on your current loan, what happens? A small piece of it goes to principal and then a big chunk of it goes to interest, right? Probably 80% of it goes to interest, especially in the early stages of a loan. So now, by taking those skipped mortgage payments and applying them towards the principal of a new loan, instead of just paying a small amount of principal, the entire amount of both of those payments goes toward principal of the new loan. So dramatically more efficient. And there's another bonus on top of that I'll get to later. This is going to feel like an infomercial because I'm going to tell you how cool this is, how much you save, and then there's going to be another thing on top of that that will blow you away. So now the question is, okay, we know what those resources are. So how can we best use those resources to maximize efficiency? And this is literally the thought process that I had when I was first figuring this out. I refinanced, I think, at least once, maybe twice before I figured this out. And so when I was trying to figure it out, I was like, gosh, what's the best way to do this? This seems silly. I'm skipping payments. I'm not making payments. It feels like they're getting over on me, and they were. So what we're going to do now is we're going to look at an example. This is going to be very rudimentary, but it's going to be a trifecta example that helps you understand sort of the numbers, where they're going, how it works, okay? So we're going to take a look at a very simple situation. Let's say we owe $500,000. And I'm going to bring in specific numbers, and we're going to look at the mortgage calculator I use, which is so cool, and I will give you that link as well so you can check it out. So let's say we owe $500,000, okay, on the current loan. This is how much is on our mortgage statement. It says we owe $500K, all right? Now we have an impound balance or an escrow balance on the mortgage statement of $6,000. This is money that's been set aside to pay taxes and insurance when it comes due. Our monthly payment is $4,000. This includes everything from, principal, interest, taxes, insurance, HOA, everything's $4,000. Now we go over here and our closing costs. What are our closing costs going to be? I always say, anticipate 2%. Sometimes it could be more, it could be less. If you have a smaller loan, then it'll be a higher percentage. If you have a bigger loan, it'll be a smaller percentage, but use 2%. Pretty safe. And with refinances, typically it's even less than that. But like I said, I don't need to split hairs with the numbers. I can be very conservative with these calculations and they still work out. So we have an impound balance of $6K. We have 2 monthly payments of $4K. That's a total of $14,000. Our closing costs are only $10,000. So what's going to happen? Well, if you did a normal refinance, what would happen is you would do a loan for $510,000, right? You do your loan for $510,000, and then you would get your impound balance check in the mail. A few weeks later, you would skip your payments here, and now you're saving, let's say, $250 a month. But you owe $10,000 more than you did when you began. So what does that mean? Well, if you're saving $250 a month, that's $3,000 a year, which means it'll take you over 3 years. It'll take you 3 years and 4 months before you break even, before you get back to where you were in the first place. Do you see how risky that is to increase the amount that you owe? So this is what the trifecta is. instead of doing that, your impound balance, you'll receive that within 2 weeks of paying off the loan. So either way, whether you do the trifecta or you don't, your balance on the new loan, your starting balance is going to be $510K. All right. So it starts $510K. Now you get this impound balance refund, $6K, within 2 weeks, paying off the old loan. And you've got a couple of months now before your first payment is due on the new loan. So what you do is, instead of blowing this money, you take this money and you set it aside. And as soon as you have the paperwork to make a payment on your first mortgage payment on the new loan, you simply take that $14K and you pay it down, so that now the balance on your loan is $496 before you make your first payment, because you're just applying these things up here to this balance here, and now you only owe $496 on this loan. When you started at $500, now we have a trifecta. We have a lower rate, we have a lower payment, and we have a lower balance on the loan before we make our first payment. That's what the trifecta is. Do you see how there is no downside here? There's literally no downside. There's no reason not to do this. Now, some people say, well, I really want to keep, that $14K. I got things to spend it on, and so I'm going to do that. Okay, well, just know you're just taking a loan out. You're basically borrowing against your equity. That's what you're doing. And if you're okay with that, then okay, go for it. But it is not efficient. This video is about efficiency, maximizing efficiency in a refi. If you want to save the most money over the longest period of time, this is how you have to do it. Okay, there's no other way. There's no other way. Now, so the new trifecta balance is lower. So let's take a look at this real quick. I'm going to show you some other considerations to look at. Other possible efficiencies, if you will, within the process. And there's one big surprise I've got for you. So now you've seen kind of where the money comes from, how you allocate it. So if you have any questions about any of that stuff, it's really simple once you understand it, but it's hard to understand. So I get it. Reach out to me, call, text, shoot me an email. I will help you understand it better and show you your own numbers with your own situation. I have a very detailed email that I create that goes through all the numbers specific to you, using your mortgage statement, your balances, your data, so you can check it out anytime if you want. Okay, so now let's look at this. So there's automatic trifecta savings. Let me see if I can pull this over here. Okay, I can. Let me do that. All right, nice. So let's use this situation here, okay? Here's what we're going to do. Automatic savings. What does that mean? How's that possible, Derek? How are we going to have automatic savings? Well, you're automatically saving in this example $4,000, right? But let's take a look. You don't have to take my word for it. Let's take a look at this instead. Okay? So the original loan amount now on our new loan is $510,000. All right? Now, what we're looking to do is to do a, let's see here, one-time payment of $14,000. All right, ahead of time. Now, by doing this, so we made this one time. This, by the way, this calculator is so good. And I'm going to show you a couple things that I use this calculator for. If you'd like to nerd out with calculators, you're going to love this. So we're using $510,000 at 6%, 30-year loan. Okay, we had that $14,000 though that we're going to pay it down to $496, right, before the party gets started. So what does that do now? It changes our loan. So not only did you get a lower balance than what you started with, a lower rate, and a lower payment, but now, because of the amortization that it's chopped off by throwing $14,000 towards the principal of this loan at the very beginning, now it also shaves 2 years and 1 month off of the loan, which results in saving you $64,000 in interest. How does that work? Well, you can look here. And by the way, I send you all this stuff too. It shows you time savings. It shows you interest savings. Because originally, if you hadn't done that and just made all the payments, you would have paid a total of this plus this. Now, instead, the total of the payments would have been $1.1 million. Now it's $1.035 because you knocked those 2 years off of interest, saving $65,000. So when I tell you that it's extremely inefficient to take those 2 months of payments and take that impound refund and go blow it on something. It's $14,000, but that $14,000 saves you another $65,000 when you just simply invest it back into the new loan. And it shaves 2 years off. So that's 2 years you don't have to make the payment. So it saves you $64,000 in interest, but also saves you from having to make that payment for 2 years. I mean, it's just absolutely massive. Now, another thing that I like to show people is if you were, let's say you were saving $250 a month on this, okay? So you were saving $250 a month and you're going to do the trifecta, but you say, you know what, Derek? I'm actually very comfortable with where my payment is right now. And so I'm perfectly comfortable. I'm going to just continue to make the same payment I've always made towards this new mortgage, even though the required payment's going to be less. So just take that $250 and add it in, and let's see what that does for us. Okay. Now what happens? Now you get to see, and I always give you these numbers, whether you plan to do this or not. I just want you to see how freaking powerful it is. We're talking about saving an insane amount of money here. Insane if you do this correctly. You pay off your loan in 23 years and 2 months. So now we're talking about shaving almost 7 years off of this loan by doing this, using the trifecta and then rolling the monthly savings back in to the new payment. This saves you $167,000 plus in interest. Just mind-boggling. Isn't that wild? Just mind-boggling. And so this gives you essentially everything that you need to see. Like if you want to, on here too, you can click on amortization. You can look at the amortizations. I believe it actually will show an amortization down here towards the bottom. No, not on this calculator. But you can click on amortization. You can look at the amortizations. You can see how much is going and where. And that's why this is so powerful at the end of the day, because it's not just about having the trifecta. It's about what is the financial effect of the trifecta. How much does it actually impact us? And by the way, remember, we are not using any money that we didn't already have. We're just making the mortgage payments we would have made anyway to the new loan. We're taking the impound refund from the old loan to help cover the cost of setting up the new one for the new loan. That's all we're doing. Taking those two payments and that impound refund and applying it to the new loan. And that's it. That's it. You do it before the first payment and you get all of those savings. How crazy is that? So we talked about making the same payment. Hey, comfortable with that? I run those numbers for everyone. Whether you're going to do it or not, when you get your detailed analysis from me, it will show you all those things. It'll show you what the cost savings are, what the payment savings are, everything. And then there's one other thing to potentially consider. And I have someone who's refinancing right now who's doing this. And he's a very, very smart person. He's shortening his loan. He originally did a 30-year loan, had it for a couple years, and he wanted to shorten the term to 20 years. Well, it actually turns out he's going to shorten it to 15 years. Now, when you start doing stuff like that, trifecta doesn't really come into play anymore because now your payment probably is going to go up. But if you can afford it because you're making a lot more money now or you have a lot more savings, maybe inheritance of money, whatever, and you're like, you know what, I'm not too worried about it. I could pay it off anytime. Let's just shorten the loan up and save some money. You can save a tremendous amount of money if you can go from a 30-year to a 20-year or 20-year to a 15-year. You can save a tremendous amount of money going that route too. It just doesn't really fit in with the trifecta and what most people are doing. So I wanted to mention that at least. So when is the best time to do this? When is the best time to refi? And I'll tell you very straightforward here. Anytime you can make the trifecta happen, it's a no-brainer. If you can end up with a lower rate, a lower payment, and a lower balance than when you started, what's the downside? Tell me a reason not to do that. There isn't one. So if you have a trifecta, then it's a no-brainer. You don't always get a trifecta. Sometimes it's not possible because of this or that. Maybe your current impound account is underfunded. Maybe there could be something going on that makes it where you can't do the trifecta. And so you have to consider other things, and we have to do some break-even calculations to see. But using the concept will make it vastly better, even if we can't get a full trifecta, vastly better than if you just did a traditional refinance, the way most people set it up. If you can get significant savings, this is a crazy number to me to put $100 a month because I would never refinance for $100 a month, but you would be shocked how many people are like, hey, I want to refinance. Oh, $80 a month. Cool. Let's do it. That is not a good move. Okay. It's got to be at least $100 a month, at least, and really should be more than that. It should be what you deem to be significant savings. If it's not significant savings, then what's the point? What are we doing all this for? It needs to be something significant. Now, sometimes with the trifecta, you can take what seems to be an insignificant amount of savings. Oh, it's only $150 a month, $170 a month. And you can turn that into a drastic savings for yourself using the trifecta method. Now, that's why I say make sure it's at least 100, because at least if we're doing that, we're calculating trifecta, then maybe it can make sense. Now, here's my biggest tip for about the best time. When you hear it on the news, okay, and you're going to hear it. Rates dropped to a multi-year low today, or refinance activity is the highest we've seen in 10 years, or you're going to see some news headlines about how low rates are. Typically, when you hear that, it is not the bottom of rates. That's not the bottom. It is just sort of the beginning of the bottom. And so it's 12 to 18 months out. Rates will, in other words, when you first hear that on the news, you've not seen the lowest rates yet. Rates will go lower than that. So just expect that that's not the bottom. Now, you still may have significant savings there. You may hear it on the news and go, gosh, but Derek, I can save $500 a month, $600 a month. Go right on ahead with your bad self. If you can save that kind of money, go for it. Okay? You can always refinance again later, especially if you use the trifecta, because remember, there's no downside. If you do use the trifecta and you refinance today, and then 6 months later rates are low enough that you want to do it again, you're not out anything. When you use the trifecta method, you don't have a catch-up period. There isn't a time in which you need to have your loan in order to have made it worth it. It was worth it immediately. Before the first payment was made, it was worth it. And that's what's beautiful about the trifecta. So you can feel if you can trifecta, you can refinance whenever you want. There's no downside. And by the way, always check with me. Always. It doesn't matter if you're even if you're in a state that I'm not licensed in. Send your refi paperwork to me every time. It is amazing to me how good some of these bad actor mortgage guys have gotten with the way they hide fees, the way that they, I don't know a way to say this, but the way that they play mind games. They've just gotten very, very, very good at it. And you may think, hey, I've got this really good deal, and it may be a terrible deal. So at least, even if you're in a state that I'm not licensed in, so I'm telling you, I know that I can't help you or make any money on the situation, it's okay. Send me your loan estimate. Let me look at it. Let me get eyes on it. It'll take me 2 seconds to tell you if it's legit or not. 2 seconds to tell you what you need to ask for or what you need to tell them. Hey, I'll do it if you can do this. All right, I'll give you the goods on what to say. If you're getting a square deal, I'll tell you, hey, this looks like a good deal. No problem. Take me 2 seconds. So let me do that for you. But always check with me. All right, here's some reminders. Number 1, understand the trifecta process and how it creates a no-brainer refi scenario. If you're going to be a homeowner, you're going to refinance, you're going to want to use this. There's nothing better. It is the best. Do not refinance if your loan balance is increasing significantly with respect to the monthly savings you are seeing. There are a lot of people who refinance, pay $15,000, $17,000 in costs, and they save $150 a month. They're not thinking about the fact it's going to take them 100 months just to break even, and how many years that is. Your break-even period on these things is a lot of times 3, 4, 5 years if you do it the traditional way, or more. That's a long time just to break even, just to get back to where you started. I don't think it's worth it. That's why I created the trifecta. And remember, this is your biggest debt. So efficiency here is not something to overlook. Don't just step past the possibility to do this. I know there are people who I coach to do this who say they're going to do it and they don't. I know because they come back and refinance again later and I can see they didn't do it. There's no judgment from me. It's totally up to you. It's your money. I don't have to make your payment. It's your money. There's no judgment at all, ever, because it makes no sense. I'm going to be judged based on how much I've shared this and how much I've tried to help people with it. But I can't help if you don't want to do it. So don't overlook this. Don't overlook the significance of what I'm sharing with you today and how profound this can be for you. Okay, now it's time. I want to find out more. Great. So how can you get a personalized proposal for TriFecta without a credit check? We don't need a credit check to propose this, okay? You basically just need to know your approximate credit score. Most people have a credit app or had a credit pulled maybe by another bank first and you're shopping around, whatever. Just tell me your score. I'll use that for rate shopping. Remember, I'm a broker, so that's how I help you get the lowest rate. We have over 80 different banks, all wholesale banks. We can lock your loan. And then if rates get better tomorrow, I can lock it again with a different bank at the lower rate. So you're never stuck when you go with us. We're never like, oh, well, sorry, we already locked your rate. No, we can relock with another bank anytime, as many times as we want. So I just need your credit score. I'll do the rate shopping for your initial lock. And then you need to provide a recent mortgage statement, the most recent mortgage statement. This gives me all the numbers I need. How much is in your impound balance? What is your current balance on the loan? So I can put all of that together for you and create your detailed email with all these numbers. And then tell me how much you think the home is worth. Okay, now I do need that to calculate rates because we need loan to value as a part of it. But I will double check what you tell me with my own comps and with what Realtor.com says, what Redfin says, what Zillow says. I'll look at all those things to make sure we're at least not being unrealistic. I want to make sure we're being very realistic about what will this home appraise for, especially if we can tell that it's going to impact the interest rate in some way. All right. Now, you should still be able to trifecta regardless, but it's something we want to make sure that we're being as realistic as possible. So I'll ask you to tell me how much it's worth. And from that, I have everything that I need to give you detailed information about what your trifecta might look like, how much you will save, all the stuff that we were showing you over here. Where is that guy? All of this stuff, I give you all the detailed numbers for all the different scenarios, including the initial trifecta, any prepayment if you want to make that based on what your monthly savings are. I give you all of that stuff in detailed form, specific with your numbers. It's really, really cool. And all you have to do, you can call or text me, this number right here. That's my cell. Or you can email me if you prefer. This email works. That's me as well. Or you can do both. You could say, hey, you could shoot me an email and then text me and say, hey, I shot you an email. Perfectly fine to do that too. I'll get back to you. We'll let you know how things are looking, what is needed, and ultimately when I will be able to get you your numbers so you can check out your trifecta. But no matter what you do, whether you use me or not, you can use this trifecta strategy to save yourself a fortune when you refinance. I highly recommend that everyone do just that. And I'll be here when you need me. Have a great one.